Chapter 5 Options. Here's the outline for this chapter. First, we will give a brief introduction. Second, we will talk about some trading strategies involving the options and their underlying assets. And finally, we will examine some examples. In particular, we will focus on the fixed income and the interest rate options. Now let's first get to know the options. An option gives the holder the right, but not the obligation, as is the case for forward contracts, to buy or sell a specified quantity of an underlying asset at a future date at the pre-specified price. A call option gives the holder the right to buy the asset, while a put option gives the holder the right to sell the asset. The pre-specified price for an option is called the strike price, or exercise price. The exercise of an option is the act of paying or receiving the strike price for the purchase or sale of the underlying asset. The exercise style dictates the time at which exercises of the option can occur. If the exercise can only occur at expiration, then the option is called a European-styled option. If the exercise can occur at any time prior to expiration, then the option is called an American-styled option. If the exercise can occur at specified time points or periods, but not for the entire lifespan of the option is called a Bermudan-styled option. The counterparty of the option, either call or put, cannot make money at expiration or exercise of the option. Hence, as a form of compensation, an initial premium needs to be paid to the counterparty by the holder of the option. The counterparty is called the option writer or option seller. Due to the payment of the premium, the option is said to be sold by the option writer to the option holder. Note that no such selling in the case of forward, as the initial value of a forward contract is 0. The option premium can be considered as a form of insurance the holder bought from the writer as a protection against loss. The option writer has an obligation to sell or buy the underlying asset at the strike price if the option holder or option buyer exercises the option. The option holder is said to have a long position on the option, be it call or put, and the option writer is said to have a short position on the option. The option holder will only exercise the option if the payoff is greater than 0. Now let's define the payoff and the profit for European vanilla options. Assume the option is bought at time 0, X is the strike price for the option, and ST is the spot price of the underlying asset at the expiry time T. For the holder of a European vanilla call option at time T, the payoff, denoted by phi t, is defined to be the maximum of 0 and ST minus X. That is to say, the payoff will be equal to ST minus X if the spot price is greater than the strike price. Otherwise, it will be equal to 0. And the profit will be the payoff minus the premium compounded to time T. For the holder of a European vanilla put option, at the expiry time T, the payoff is defined to be the maximum of 0 and X minus ST. That is to say, the payoff is equal to X minus ST if the strike price is greater than the spot price. Otherwise, it is equal to 0. And the profit is the payoff minus the premium paid at time 0 compounded to time T. The payoff and the profit for the option writer for both call and put options are exactly the opposites of that for the option holder. The option premium is essentially the present value of the expected payoff. With certain assumptions, notably geometric Brownian motion parts for the underlying asset price, Closed-form formula have been obtained for European vanilla call or put options. For many other options with more general payoff functions, American-styled exercise, and more general price dynamics, typically there is no closed-form formula for the option premium. The moneyness of an option is an indicator whether the option payoff would be positive if the option were exercised immediately. If the immediate exercise payoff is positive, the option is said to be in the money. If it is negative, the option is said to be out of the money. And if it is zero, the option is said to be at the money. This immediate payoff is also called the intrinsic value of the option. Besides the exercise styles, the options can also be categorized by their underlying assets. If the underlying asset is the share of a company stock, the option is called an equity option. Most trading of equity options occur on exchanges such as Chicago Board of Exchange, Nasdaq OMX, NYSE Euronext, etc. Each contract gives the holder the right to buy or sell 100 shares at the specified strike price at specified expiry dates. If the underlying asset is a particular foreign currency, the option is called a foreign currency option. Most tradings of foreign currency options occur in the over-the-counter market, but exchange tradings could also be found at Nasdaq OMX. Each contract of a foreign currency option gives the holder the right to buy or sell a fixed number of units of the foreign currency. If the underlying asset is the stock index of a particular market, the option is called an index option. The most popular ones being those traded on S&P 500. Trading of index options can be both over-the-counter or on exchanges, such as Chicago Board of Exchange. Each contract of an index option gives the holder the right to buy or sell 100 times the index at the specified strike price at specified expiry dates. If the underlying asset is a futures contract, the option is called a futures option. Most tradings of futures options occur in exchanges where futures are traded, such as Chicago Mercantile Exchange. The option typically expires before the expiry of the futures. Each contract of a futures option gives the holder the right to enter into a futures with a long or short position at the specified futures price. For options traded at an exchange, the terms would be fixed by the exchange. Such terms include the size of the contract, expiration time, and the strike price. In the United States, the size of each stock option is 100 shares. The expiration date is the third Friday of the expiration month. Several options with different expiration months are available. For options traded in the over-the-counter market, the terms are more flexible and are tailored to the needs of the parties involved. That's all about the introduction of options. Next lesson, we're going to introduce the trading strategies involving the options and their underlying assets.